Do you own a home? Well, what if I told you there's a way to get the IRS to help pay your mortgage every single month? But not just your mortgage. I'm talking your mortgage, property taxes, homeowner insurance, repairs, all that. And if it sounds too good to be true, I promise you it's not, because the wealthy have been doing this for years. And today, I'm going to peel back the curtain and give you the game that the gatekeepers have been keeping away from you all this time. Not only that, but I'm going to give you a second strategy teaching you how you can get tax-free rental income from your own home. All that plus more in today's episode. So there are two strategies that you can take advantage of to have the IRS help pay or reimburse you for your mortgage. All right. And before we dive into the details, let me ask you this. Like, if you have a business and you're not working from home, you are leaving so much money on the table. Okay. So both of these strategies require you to have a small business. I've said this time and time again, guys. If COVID taught us nothing, one source of income is too close to no sources of income. So even if you have a W-2 job, still start a side business so you can take advantage of some of these amazing tax deductions. So if you want to take advantage of both these tax deductions, you have to meet two requirements. Number one, you have to have a small business. Number two, you have to have some space in your home where you solely work. As you all can see, I am in my content studio, in my home office, in my home, right? Because I want to make sure I maximize my deductions. So some of you all have heard me talk about the home office deduction. Some of you all have heard me talk about the Augusta rule. These are two strategies that help you write off a portion of your rent or mortgage. Now, which strategy is better is a phenomenal question. And before I answer that, let me break down the home office deduction and the Augusta rule for you new viewers, and then we can talk about which one is better. Okay? So, strategy number one of how to write off your mortgage goes as follows. The IRS clearly states that if you have a business and you have a dedicated place where you solely work, you are able to take advantage of the home office deduction. Okay? And guys, when I say it has to be a place that you solely work, I mean it has to be a place where you solely work. It cannot be your kitchen counter that you cook breakfast in and then work in the afternoons. It has to be a dedicated space where you solely work. This could be a secondary bedroom. This can be a basement. This could be a den, but it has to be a place where you solely work. All right? If that is the case, you will be able to take advantage of the home office deduction. So I'm going to give you an example of one of our clients that took advantage of a home office deduction and how much of their mortgage they were able to deduct on their taxes. So the first thing you want to do is you want to calculate the square footage of your entire home. All right. Now, this client's square footage of their home was 1,000 square feet. Okay. They had a condo, 1,000 square feet. All right. So that's the square footage of their home. All right. Now, the second measurement you need is the square footage of the home office. Okay. Now, the square footage of their home office was 250 square feet. Okay. Now, some of y'all are probably asking an interesting question. Carter, if their home was only 1,000 square feet, and then how was their office 250 square feet? Doesn't that mean the office took up a quarter of their home? Yes. Here's how they did it. This particular apartment was a 2-bedroom apartment, right? Which means that they had the option of turning the primary bedroom to a home office or turning the secondary bedroom into a home office, right? So what they decided to do was they decided to, instead of turning the main bedroom instead of turning the master bedroom to their main bedroom, they simply decided to turn the master bedroom into their home office to increase the percentage of their deduction. The whole apartment is theirs anyway. So they said that I'm going to make the master bedroom my home office. The secondary bedroom could be my bedroom because I'm more interested in my tax deduction than I'm interested in having a bigger room. So step number 3 is you need to take the square footage of the home and divide it by the square footage of the apartment. And this gives you the business use percentage of your home. Okay. This gives you the business use percentage of your home. So that means in our example that 25% of their home is recognized by their business. Okay. That means that 25% of their home is recognized by their business. Now, so now that we have our business use percentage, the next thing we need to do is we need to add up all living expenses. Okay, we need to add up all living expenses. So this includes our mortgage interest. This includes our property taxes. This includes our homeowners insurance. This includes HOA fees. Okay? And guys, mortgage interest, not the full mortgage payment, okay? Because only the mortgage interest is tax deductible. Newsflash, in case you haven't checked your statements, the first 5 years of your mortgage, you're paying 90% of your payment is going towards interest. Okay? That's why we don't like refinancing, because it starts the process over. That's a conversation for another day. Okay? Electricity or utilities, internet, etc. So you need to add up all the expenses that it costs you to reside in this residence. So when we added up all of the client's expenses for the year, it came up to about $24,000 a year. Okay? It came to about $24,000 a year. Now that we know that, the last thing we need to do is we want to multiply the business use percentage multiplied by living expenses. Okay? So that is $24,000 times 25%, which brings us to, pull my calculator, that brings us to $6,000. So our client was able to write off $6,000 of their $24,000 via the home office deduction. That means that the IRS basically paid for 25% of their living expenses. What's up, family? Are you ready to make more in 2024? I'm talking make more money, pay less taxes, and get access to more capital. If so, I want you to join our 100% free masterclass, where we're going to be teaching you all of these strategies so you can keep more money in your pocket and you can make your money make money for you. So if you want to be a part of this amazing free class, all you have to do is click the link below and save your spot. The problem is we only have 50 seats. So I will pause this episode, go register, and come back to it after so that you can save your seat for this masterclass. Other than that, I'll see you inside the class. Let's get back to the episode. How much better would your life be if the IRS covered 25% of your living expenses? Right? So that is strategy number 1, home office deduction. Now, let's talk about strategy number 2, which is called the Augusta rule. Okay? This is called the Augusta rule. Now, the Augusta rule is extremely powerful. It is one of my favorite tax strategies ever. Okay? Because the Augusta rule allows you to rent out your primary residence to your own business. You can then charge your business rent, and you can then receive the income personally tax free. It's one of the craziest strategies I've ever heard. Let me break it down again. With the Augusta rule, you're able to rent out your primary residence to your business, right? Your business then pays rent for the use of the space. You get a your business gets a deduction for the rent that it pays to use the space. You're the owner of the home. So you're receiving the money from your business, and you receive the money from your business tax free. So we get a tax deduction in our business, and we get tax-free rental income in our personal life, and which makes it one of the best tax strategies that we can take advantage of, especially when it comes to deducting our living expenses. So here's a few rules about the Augusta rule, y'all. Here's a few rules. Number one, you can only do this for 14 days or less, okay? You cannot take advantage of this strategy 14 days or less per year. So the maximum amount of times you can rent out your primary residence to your business is 14 times a year, okay? The second rule is you have to find, make sure I'm on screen here. Second rule is you have to find comparable rental rates, okay? You have to find comparable rental rates, which means you can't just charge your business whatever you want. You can't say it's $1,000 a night. You have to go on Airbnb or VRBO, look up your apartment, look up your house. If you got a 2-bedroom, 2-bathroom condo in downtown Los Angeles, you need to look up condos in your area to get a comparable rent rate. Okay, that's rule number 2. Rule number 3 is you cannot have the same address for your home and your business. Basically means your business and cannot have the same address as your primary residence, which shouldn't happen in the first place because your business address is public record. So if you have your business address if you have your primary home as your business address, anybody can look you up, find you, harm you and your family. So you don't want to have that anyway. Number 4 is you have to create a rental agreement between you and the business. So you have to have a rental agreement between you and the business in order to do this. And last but not least, you have to do business activity in the home. Okay? So the days that you rent out your home to your business, you need to be doing business activity. You need to be hosting, and business activity is simple. You can host a meeting, you can host a mastermind, you can shoot content, you can record a course, you can you can host a meeting with the employee and the employer of the business, which is both you. Okay? Now, if you do this, you are able to take the Augusta rule. Now, again, let's talk about how the numbers work, right? So we had a client that lived in Phoenix, Arizona, right? And their comparable rent rates. So their comparable rent rate was $1,000 a night. Okay? Now, they did have a big house, right? That's why it was able to get this rent comp. So they were like, okay, Carter, I'm ready to take advantage of the Augusta rule. So my rent comps is $1,000 per night. I can do this. I can do this for 14 nights. And each night I'm gonna have my business partners over. We're gonna have a mastermind. We're gonna talk about marketing, social media strategies, whatever. So does that mean that I get to charge my business $14,000? I said, absolutely. Your business is going to get a $14,000 tax deduction for rental expense for using your home. And guess what? So this is a tax deduction, right? And on top of that, you're going to receive this $14,000 in your personal account tax free. So now not only did his business get a $14,000 tax deduction, but he was going to receive the money tax free. Now, I then said, "Hey brother, have you picked the date and when you go do the Augusta rule?" He said, "No, I don't know when I'm gonna do it." And I said, it was January at the time. And I said, "Well, have you checked the calendar?" He said, "Yeah, why?" I said, "Do you know what's happening in Phoenix, Arizona in the month of February?" He said, "No." I said, "One of the biggest sporting events is happening in your town next month. It was the Super Bowl with the Kansas City Chiefs versus the Philadelphia Eagles." He said, "Carter, why does that matter?" I said, "Because rental rates change depending on when you decide to take advantage of the Augusta rule. So if you do it all 14 days leading up to the Super Bowl and after the Super Bowl, your rent comps are going to jump." He said, "Man, that's genius." So when he did his rent comps the second time, when he looked it up from February 1st to the 14th of that year, he had an average rental rate of that timeline of $2,400 per night. Okay? And at 14 nights, I'm sorry, not 1,400. At 14 nights, what does that mean? That means his Augusta rule deduction was going to be 14 times 2,400, which is now a $33,600 tax deduction that his business was going to get. And that means that he's going to get this $33,600 tax free. Do y'all see the power of the tax code? Do y'all see the power of leveraging the tax code to your favor? So this was a scenario. Now, he came back and said, "Hey, Carter, I used the home office too. Can I take both deductions?" I said, "No, you have to pick." He said, "Well, which deduction is more?" He said, "Which deduction is better? Is it the home office deduction or is it taking the Augusta rule?" And I'm sure that's the question that some of you all have. So let's address it right now. So which deduction is better? So first of all, it's going to depend on your situation. So if you rent, meaning you don't own, you can't take advantage of the Augusta rule, which means by default, you have to take advantage of the home office deduction, which is great. Okay. If you own a home, 9 times out of 10, the Augusta rule is going to yield a better tax deduction than the home office deduction, right? On top of that, you can now, if you take the Augusta rule, you are now able to double dip. Because if you own a home and you decide to itemize your deductions, you'll still be able to write off a portion of your property taxes and your mortgage insurance anyway. So you'll be able to dip once on your 1040 of your tax return via itemized deduction, and you'll be able to dip again on your business tax return via the Augusta rule. So you can it's not actually an either or, it can be a both and. And this is the power of understanding the tax code. This is the power of having a great tax strategist. And this is the power of learning more so that you can start earning more. And if you like this video, if you got some information from this video, please share it with somebody you know. Let me know in the comments below, which will you be taking advantage of? The Augusta rule, the home office deduction, or both? See you next time.